एक स्कीम है, अमीरों की स्कीम मेरे हाथ लगी है। 25 दिन में पैसा डबल।
25 दिन में पैसा डबल?
Well, we all know how that went, but don't we secretly wish for such things to actually happen, for such schemes to really work? Well, if you are not comfortable with finance and investments, and if you don't know what to do with your money, you have arrived at the right destination. I am Tanya and welcome to my channel Wikividya. In this video, I'll be explaining the very basics of investment, that is why you should invest, what factors should be considered before investing, what are the different asset classes, and how you should choose the best investment option according to your age. Well, of course, no one can guarantee to double your money in a specified period of time, but instead of keeping all your money in the bank, you can use a part of your money to make more money. So let us start by first understanding the factors that you should keep in mind before you start investing. The first factor to be considered is inflation. Now, if you have rupees 100, its value today will be more than what it would be at any future date. This is because the prices of commodities like food or clothing or anything that you buy in the market will keep on increasing, but your 100 rupees will still be the same. Inflation reduces the purchasing power of money. So we have to keep in mind that we have to beat inflation. The second factor to keep in mind is your goals. Now, every person has different goals. Someone wants to buy a house, someone wants to travel the world, someone wants to start a new business, etc. etc. So, your goals are also important to determine the best investment option for you. Another factor to be considered is your retirement planning. Some people start their retirement planning after they are retired, which obviously is not the best plan. So you should start creating a retirement fund while you still have a fixed monthly income, so that when you are retired, you can live comfortably and take care of your medical expenses. Now that we have understood the different factors for investment, let us understand the different asset classes. There are hundreds of financial products available in the market, which can make it quite confusing for you. There are fixed deposits, mutual funds, ETFs, PPFs, etc. Now, an asset class is like a big basket that groups together the financial products that have same characteristics like risk, return, liquidity, and other parameters. There are a number of asset classes, but most of the investment options can be categorized into these top 4 asset classes. The first one is cash. It could be physically with you or kept in your bank account. Keeping your money in the form of cash gives you very high liquidity with very low risk, but the returns are also very low and not sufficient to beat inflation. In July, the inflation rate in India was 6.93% and the interest rate on savings account in SBI is 3.25%. However, it is advised to keep a certain part of your savings as cash because it gives you the freedom to buy anything instantly. The second asset class is fixed income or debt investments. These include government bonds, debentures, and the most common financial products in India, fixed deposits or recurring deposits. The interest rate on fixed deposits in India range anywhere from 5 to 7%. Debt investments give you moderate returns with very less risk, but it is not advised to invest all your money in this category. The third category is real estate. The returns from real estate are very volatile and can depend on various factors like the city where it is situated, government policies, political situations, etc. So keep all this in mind while investing in real estate. Also, the liquidity is very low in this category because it can take you a year or more to take out your money. And the last asset category is equity. Equity means ownership. So when you invest in equity, it means that you have bought ownership into a business. Now, people who want to grow their wealth or save for their retirement invest in equity either through stock market or through mutual funds. Investing in equity can have moderate to high risk, but the return is also high. The financial market is volatile and the share prices keep on changing every day. Therefore, you should wait for 3 to 6 years to realize the full potential of your investment. Now, to decide how you should invest in these assets according to your age, there is a simple rule of thumb, that is 100 minus your age. So, if you are 25, you should invest 100 minus 25, that is 75% of your total money in equities, and the remaining money you can put in less risky or safe assets. Similarly, if you are 60, you should invest 40% of your money in equity and the remaining in low risk assets. This is because when you are young, you can afford to take more financial risks as compared to when you are old. But of course, there is no hard and fast rule, and you can definitely customize your portfolio as per your goals, plans, and risk taking capabilities. If you found this video helpful and would like to see more such content, make sure to hit the like button and subscribe to my channel. And if you have any queries or feedback, feel free to leave a comment below. I'll see you next time. Bye.